Hey everybody, this is RC Pack, and this is my weekend podcast. Happy Thanksgiving weekend to everyone in the United States, and I guess celebrating Thanksgiving regardless of where you are living. And before we get to that, I want to show you this one chart here. Now, this is, I guess it's more of an image than a chart. There are 3,000 counties in the United States, 3,000. Hillary Clinton won less than 20% of them. Kind of interesting. Of all the counties, and there's 3,000 of them, and they're different sizes, but Hillary Clinton, she won less than 20% of those counties. And you can see those, the blue part on the screen here, all those counties. Now, they happen to be the largest counties in the country, but she won less than 20% of them. The other 80% plus went to Donald Trump. Now, what's so interesting to me about this is 2/3 of the country, of the GDP, like 2/3 of the country's GDP voted for Hillary. And that just struck me as a really interesting way of looking at election results, like from a, GDP point of view, from a production point of view, that the, 2/3 of our GDP voted for Hillary Clinton and 1/3, again, this is roughly, voted for Donald Trump. So I think the biggest loser really over the next 4 years, and this is not me being cynical, and please no hate mail, I think the biggest loser over the next 4 years is going to be poor working class people. You're right. Just like Black Americans, I don't think their lives got better with 8 years of Obama. In fact, the statistics say their lives, America is about 12% Black, and that 12% did not get richer under Obama. And it's very likely that Trump's core base, whomever they are, which is fine, whoever they are, they're not going to quite get the experience they want under him, right? Because right now he's elevated so high. But when I learned that 2/3 of the economy voted for Hillary and 1/3 of the economy voted for Trump, that just was a really interesting way of framing kind of voting across this country, which is huge, about 340 million people. So I love data when it's presented in a kind of a visual way. So with that, let's move to gold. Now, if you look at this price chart here, this is gold, and this is gold in 2011, 2012, and 2013. Now, if you look at this, this is the peak of gold right here at $1,919, right, at the very end of August in 2011. And then it chopped sideways all through 2012, which is here, beginning of 2012, and here's the end of 2012. It chopped sideways, and it stayed above $1,550, which is what the black line is. And then in April in 2013, it went through it very hard. And it gold really didn't start falling until April of 2013, because everything before that was just a chop sideways. Now, we didn't know at the time it was topping, but that was gold topping. And it was a very messy process. Gold basically was bouncing between $1,550 and $1,750. Those are big bounces. That's a $200 move. Topping is a messy process, and so is bottoming. Now, this is gold today, like literally right here today. That's gold over there on the right side. Well, it's GLD, but the price chart, it's the same looking price chart if it was gold. Now, we know that gold bottomed at the end of 2015 after falling in 2013, 2014, and 2015. And then it bottomed, and it went from $1,040 up to about $1,300, right? So it went up $260. And since July, it's been falling, right? It fell from about $1,300 and down today, it's about $1,200. These represent GLD, but I'm telling you it's about $1,200 today. So it's down about $100. Now, the topping process, and I'm not saying the bottoming process has to be a $200 sideways chop, but the topping process basically was a $200 sideways movement for 18 months. So it would not shock me if the bottoming process was a sideways, first of all, was a sideways chop. If you look at the screen here, it is going sideways. It fell here in 2015. It's gone up. But when you zoom out and you look at this 2-year price chart, which just is 2 years of data, it just kind of looks sideways right now. And so gold is clearly still in a bottoming process. Now, if it breaks below the 1040, which it had a double bottom in December, then then I will say no, in fact, it didn't bottom, but we don't know that yet. And I'm not saying it's going to break down below 1040, but I want to point out and make a couple points here. Tops and bottoms are messy and they chop sideways for a while, and that is what's going on with gold. And that is to be expected that there is a sideways chop. Now, this peak right here is the election results that Trump is going to become the new president of the United States. And you can see prior to that, gold had bottomed and started moving up. So I'm going to go to another price chart. And this price chart is the actual price chart of gold and not GLD. But here you can see the bottom of gold at 1040 down here moved all the way up to August. And I was saying 1300 before, it's 1375. So it did a pretty good move. And since then, it's fallen from 1375 down to 1200. It broke below 1200 today. So that's a fall of $175. Now, it wouldn't surprise me if gold also chopped back and forth at kind of the $200 range. Couple things that have caught my attention. One, once the world knew that Donald Trump was going to be the new president of the United States, gold's off 9% and has been falling almost every day since he's been president-elect. Now, that is interesting, and that is something that we should take note of. And the reason is because gold has not fully solidified its upside trend yet. It is in the process of creating a bottom, and the fact that news changed the direction of it. Now, gold in some ways is directionless right now over the last 12 months because it is looking for its bottom. And it's very likely that gold has bottomed at that 1040. We just don't know yet. But it's going to be bottoming. We clearly know that because that's what it's doing right now. So gold is retracing right now from its most recent move from 1,040 to 1375. It stopped at the 38% retracement. These horizontal lines are Fibonacci retracement lines. And when gold fell, it did fall to its 38% retracement line, started moving higher. President-elect Trump, right, happened right there. And then it moved back down. It did not stop at the 50%, or it barely stopped at the 50%. And now it's coming down to what I'll just call the 62% retracement. So that is important. Where we're going, I don't know yet. It's hard to say simply because it's in a sideways chop and tops and bottoms are super messy. That I know because I've been doing this long enough that bottoms and tops really scare people because they drag things out. So it's a perspective that I wanted you to see that, most people actually aren't talking about right now. So what is the takeaway? The first takeaway is tops and bottoms, all right? They have their own unique characteristic. They're very similar to each other, but they are more drawn out, especially when you're in the thing that's topping or bottoming. So they can bring up a lot of emotion. But the first thing is they are absolutely gut-wrenching. And so anyone who's in gold right now, especially having lost money in 2013, 2014, and 2015, is probably experiencing some wrenching in their gut. The second is with anything you buy, there has to be a point in time you say, I think I might be wrong. Whatever it's with, an individual stock, the S&P 500 in gold, you have to know the point in time where you are saying, you know what, I may be wrong. And so it's the same thing with gold. Look, I think gold has a very good future. I think with what Trump is saying about printing even more money, having our debt, the U.S. debt, get even bigger. Under Obama created $10 additional trillion of debt in his 8 years, biggest ever for a president. It's very likely that Trump could do another 10 trillion in 4 years. Is that possible? It is actually quite possible considering all the deficit spending we're running at and if there's more printing. So you have to have a stop loss. You have to know the point in time where you're wrong. And then lastly, please know your leverage. Please know your leverage. If you buy silver, I'm going from memory here, but you'll get the point. If you buy silver, silver is about 2x leveraged of gold. If you buy precious metal mining shares, GDX, that's about 6x leveraged of gold. If you buy a 300% leverage of GDX, which is NUGT, that's about a 25x leverage of gold. And if you were to buy small cap precious metal mining leveraged up 300%, that's actually a 30x leverage of gold itself. So you really have to understand and know the actual leverage you're in, and most people don't. And what they do is they go in, they're like, all right, I'm going to get in, I'm going to back the truck up, and they go with a 30x leverage, not knowing it's a 30x leverage. And then the market goes sideways for 9 months, 12 months, 18 months, and it just kills them, and they finally get out. Leverage can be good, but you got to know what your actual leverage is, and I find that most people don't. So I will absolutely keep tabs on precious metals and watch what's doing, and I have a strategy called LTech Gold that shows you when to be in it and when not to be in it, it being gold, and shows you how to leverage up properly. That's called LTech Gold. And so I will keep everyone in, all paid up members in the loop with that. But those that aren't, you really have to be super on top of what you're actually doing, because things can get really dangerous really fast. Hey guys, this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck. Hey guys, I just want to point out one thing that I'm doing, and I'm super excited about it. I have this new training webinar called the 3 filters, or the 3 magic filters. And I did one this week, and after I got done running the training webinar, I realized that there were a couple things that I want to make sure that are in the training webinar. So I am retooling the training, and it went great. It was on Monday. It was this past Monday, and it went great. And I just realized, you know what? There's a couple things that I think I can bring even more clarity into it, and I call it the 3 magic filters. And it's pretty cool, because basically what I'm going to show you is how to take all of the ticker symbols on the planet, and there are a lot of them. Just in the US, there's 20,000 stocks you can buy. That's a huge number. That's just stocks. There's another 10,000 mutual funds you could buy. There's another 4,400 exchange traded funds you could buy. I mean, the amount, and that doesn't even count all the bonds you could buy. It is a huge amount out there. And so just because they're all out there doesn't mean you should be paying attention to them. And the 3 magic filters literally filters out all the noise, all the confusion, all the complexity, even your own behaviors that might hurt your money. They literally filter out all that information. They literally tell you where is the best place to put your money, what is the best size stock to have your money in, and what is the best type. I said type. Size and location. It tells you all 3 of those. It doesn't have to be complicated. Even if what you're trying to solve looks complicated, oftentimes a simple solution is the answer. You guys take care. I will let you know clearly when that's coming up. Thank you for being in my world, and I look forward to connecting with you soon.